Okay. Well, good morning and good evening, everybody, and welcome to the first Economists Forum hosted by Speevr, a new information service that's being set up and brought to you here on YouTube. We've got three very distinguished economists as our guests. I'm going to briefly introduce each of them in turn and get them to speak on their favorite themes. And then we'll be throwing it open to questions from the audience, and we'll be starting a discussion amongst ourselves. Let me start with the US. Let me start with Larry Meyer, a former Fed governor, academic at Washington U, graduated from Yale and MIT, and is currently an independent economic advisor. Larry, over to you, please.
All right. Well, my life is the FOMC. So what I'm going to talk about is what's driving monetary policy and where it's headed. So I think we want to start with the fact that the U.S. economy has been growing at a 2% rate over the recovery period. That turns out to be pretty good cyclically, because it's been high enough to put the unemployment rate on a downward course from above 10% at the beginning of the recovery to below 5%. And this has contributed to inflation rising now to 1 3/4 for core, to above 2 for headline inflation, and confidently with core headed towards 2% this year or early next year. So let's look at the initial conditions and the forecasts that are driving monetary policy today. 1, we're at full employment. 2, we're on our way to 2%. We've achieved or on our way to achieving the dual mandates of the Fed. At the same time, the economy continues to grow at an above trend rate, so the unemployment rate is going to continue to fall, and monetary policy is still accommodative. Well, monetary policy under these conditions, it's not rocket science. The Fed should be withdrawing its accommodation, and it says it intends to do so gradually. Gradually is not once a year. Gradually means slow but continuous. And if we go back to the end of 2015, we'll see what their plan was, and indeed is today. The plan was to raise the funds rate 4 times a year, every other meeting, and that was defined at that time as gradual. But they only raised rates once. What happened? Well, the plan got derailed again and again by events that are going on in China, associated financial turbulence, other times financial turbulence, blips in the data, Brexit concerns. So they didn't get to carry through. So what's the story this year? Back to the plan, back to gradualism. And right now, the committee anticipates about 3 or 4 hikes this year. The median is 3. 3 next year and 3 the following year. And we have to understand where this is headed. Monetary policy in withdrawing accommodation is trying to move the funds rate to its neutral rate, which will be consistent with being at and remaining at full employment and price stability. And that's exactly what this will do, take the funds rate to 3% by the end of 2019. Now, there are a couple of complications here. The first is that there are 2 ways of withdrawing accommodation. One is by raising the funds rate, and the other is by balance sheet developments, ending reinvestment, and running off the portfolio. More of one means less of another. Using the balance sheet means fewer hikes. And so one of the big decisions of the Fed is how much balance sheet developments are going to substitute for rate hikes this year and next year. The other complication is I kind of been talking like this is the FOMC that's going to make these decisions over the next 3 years, and it's not. Okay, it's going to be Trump's FOMC. 3 vacancies this year, at least 2 next year, an entirely new FOMC by the end of 2018. So we have to say, what kind of governors, chairman, etc., does Trump want? Well, it may seem hard to say, but I certainly have a view. And I call the principles here, don't rain on my parade, and academics need not apply. He wants a committee that's going to test the limits of growth, accommodate what he sees will be faster growth with his policies. He does not want a hawkish committee. Oh, not at all. He wants a more dovish committee. And what he's probably going to get is a committee pretty much like today. So I come back to the fact that what this committee will do will not be that far different from what will happen. A somewhat cautious committee in response to added fiscal stimulus that will call for a faster pace of rate hikes than otherwise. So that's my summary of the U.S. outlook, U.S. monetary policy, and Trump.
Thank you very much, Larry, and raised several issues there that I want to come back to, but thank you for that introduction. Next, we should move to Europe, and we've got John Llewellyn with us. Many years at the OECD in various positions, then global chief economist and subsequently senior economic policy advisor at Lehman Brothers, and now also an independent consultant with his own firm. John, tell us about Europe and tell us about Brexit.
Yes, well, on the day when Mrs. May has triggered saying that the UK is going to leave definitively the European Union, it's very hard to talk about anything else. Here, I'm a New Zealander. I grew up in that country, and so I don't really have a dog in this fight. The question of Brexit has turned out to be enormously divisive, with people passionately in favour and equally passionately against. Person who is something of a bystander, I look at this with a here is the United Kingdom, no longer a big country, a country which is less than 3% of world GDP, contated, right on the edge, largest free market. And what does it decide to do? And if it decides to exit that market, and exit it pretty thoroughly, because it says, leave the single market, we don't even want to belong to a customs union, to a free trade agreement market. So really at root, I think, for two reasons. One is we want to be subject to the European Court of Justice. Ordinary in this process, the views that have been expressed. And certainly as a professional economist standing looking at this, an awful lot of the things which have been said are simply not true. It's been said, for example, that this will give the United Kingdom a wonderful opportunity to explore new markets and so on. As we've got, and Europe free trade states, not as big an importer of products that the UK exports as Europe is, and after that, but really significantly smaller countries, India. I look at this again through my New Zealand spectacles, and I reflect that when I first came to this country in the 1970s, we had to go through a period of because when Britain joined the common market, one of the conditions was that New Zealand cut its exports to UK and then put them on a declining trend thereafter. Through 15 years of really difficult structural adjustment, unemployment went up from less than 1%, 0.1%. Trade agreements all around the world and to diversify to its economy and so on. And many New Zealanders will tell you it's stronger for it. Getting from here to there was a traumatic experience. That's the to leave Brits with today, which is you may have taken a step in years from now to your economy being more diversified, stronger, more varied than it is at the moment. But getting from here to there, unless you go through a trade agreement which is pretty much like what you've got at the moment, stands to be traumatic. So those are my
Thank you, John.
On the UK.
Thank you very much, John. That's very good. I'm sorry if anybody's experiencing some sort of delays and mixed sound quality. I'm sure we're trying to fix that. And then for our third speaker, I'd like to turn to George Magnus, who has worked for many different investment banks in his time, and was for a long time senior economic advisor and previously chief economist at UBS, of course. And I'm glad to say is also a regular contributor to my own paper, the Financial Times. George, I think you're here as partly as our Asia and China expert, so maybe you could give us a couple of views on that.
Yeah, thanks, Dan. So the curious thing about looking at China this year is it's gone almost completely off the radar screen as far as the economy is concerned. I mean, Larry Meyer referred earlier to situations that cropped up in 2015 and 2016 when, amongst other things, China deflected the Federal Reserve from its chosen course of action. I mean, I think we all remember very well the stock market and currency problems that China had in 2015, and then winter of 2015-16, and then last year, the capital outflow problems during the second half of last year. But as I'm sure everybody knows, as a consequence of capital controls, which were tightened at the end of last year, and due to a number of measures which the government has taken, the economy has become very boringly stable. So whatever you think the growth rate is, and it's variously estimated at anywhere between 4.5% and 7.5%. Obviously, the government numbers are around 6.7%. Nothing much is going on, except that since the autumn or fall of 2016, there has been some recovery in some economic indicators. Now, I would say this is not kind of a new growth cycle or an acceleration in the old growth cycle, but it is a stabilization, which is precisely what Xi Jinping and the leadership wanted to happen in this of all years, because as is also very well known, at the end of 2017, the 19th Party Congress will be, which is the kind of the halfway house in the 10-year term of office of the leadership. Sorry, I was just getting an interrupted call there. A very important event for Xi Jinping, both constitutionally and from the point of view of his personal agenda within the context of the Communist Party and his core leadership. So we have seen very great, stability in industrial production numbers. Export numbers have picked up a bit, which have not really been much to do with the Chinese economy specifically, but the recovery, such as it is in world trade, which I think has come as a little bit of a pleasant surprise, I would say. Producer price index numbers are back in very strong positive territory, mostly thanks to coal, iron ore, and other raw material prices. And some of the construction indicators that we've been looking at, like floor space under construction, floor space completed, infrastructure investment, and particularly the investment coming from public sector, from state-owned enterprises, has been on the rise deliberately, because this was part of the government's policy to stop the economic decline or the decay in the growth rate that was going on in 2015-16. So that's kind of where the economy is. It's not a particularly interesting story, unless you're interested in, obviously, the stock market, which is responding now a little bit positively to these better economic numbers. But it's not. It definitely doesn't fit the script that we had for the last couple of years of China in crisis. So behind the scenes, of course, there is something else going on. There is a very interesting narrative about China's credit cycle and its debt problems that everybody's very familiar with. And there really isn't much change going on there, which is that despite a nominal slowdown in the reported rate of credit creation designated by the total social finance indicator, which is corroborated also by a slowdown in the broader financial claims series, because later in the month, after the total social finance numbers come out, we get data for lending or claims on non-banking financial institutions and bank lending to public sector entities. mostly local and provincial government agencies, which used to be called financing vehicles, and they are now masquerading more as public-private partnerships and local investment schemes and so on. These numbers are still growing at a very, very rapid rate. And it's peculiar, even during the course of this year, when we've watched the People's Bank of China push up interbank rates and other policy rates by between 10, 20, 25 basis points. People have spoken a lot about, you know, the People's Bank of China is on a tightening mission. That's, I think, a little bit of an exaggeration, to be honest. I mean, the direction of travel of interbank rates and of policy rates, of course, has been up rather than down. But anybody that's familiar with tightening cycles in China knows that if the People's Bank of China wanted to achieve anything, or if it had instructions to achieve anything that was in any way serious about putting the credit genie back in the bottle, we would see interest rates hundreds of basis points higher than they are today. So I think the instruction from Uncle Steve really is still that, you know, the growth target, as we've seen, the National People's Congress recently, has been preserved at around 6.5%. And the instructions from the State Council are that whilst the regulatory agencies, I think, are becoming a little bit more anxious about bond markets, repo market, second mortgages and property and so on, the bottom line really is that credit expansion and the funding structure of the liabilities behind that credit expansion are still pretty much out of control, I would say. You know, what happens after the 19th Congress, I don't really anticipate any big shocks between now and the end of the year. But clearly, all eyes will be on what happens to policy after the Congress, indeed, whether it changes. Obviously, there are potential googlies in between. Googly is a cricket expression, by the way, for those that don't know the English game. The potential googlies obviously could be some of the information which is being thrown up by the China Red Book survey, by the Chambers of Commerce, US China Chamber of Commerce and European China Chamber of Commerce in Beijing, which both report on, you know, troublesome trends in terms of the lack of reform agenda and the way in which the focus on state enterprises and infrastructure has become all consuming. And obviously things could go wrong with capital flows at any time, given that the amount of credit creation, of course, is running far ahead of the growth in monetary base. So, and of course, the trade agenda with Trump could actually explode at any time, not because the Chinese want it to, but because the Trump administration, if it's looking for wins at home, may certainly use trade, and automobile trade in particular, is what I'm hearing, as a catalyst for stirring the pot if and when Xi Jinping comes to Florida later in April.
Thank you very much. Very thorough explanation. We've got a viewer question for John in Europe about the Bank of England, which is, you know, that given that the headwinds for Brexit and the very high leverage already in the system in the UK, how does the BOE extract itself from QE, or can it at all extract itself from QE?
I think that's a very good question, and the answer is it's going to face a very tricky choice. On the announcement that Mrs May would trigger Article 50, sterling fell instantly by 15% and has climbed ever since. And that's going to contribute to an acceleration of inflation, which most economists would say will probably peak at 3% or a little higher. If all that happens, then I think the Bank of England would be able, as it is said, to look through that and say, yes, it's going to rise to 3%, but then it'll slowly subside, and therefore we don't have to do much with monetary policy except leave it fairly easy for quite a long time to offset the weakness of demand, which I, for one, expect will come as a result of weakening exports and weakening investment. If, on the other hand, these negotiations go badly, which is a distinct possibility, although by no means a certainty, possible that sterling would take another leg down. then the Bank of England would have a real conundrum on its hands. Would it tighten policy in an effort to contain inflation, which would then have stayed above 3% for a long time? Or would it ease monetary policy further in order to support demand, which I'm sure under those circumstances, that is the dreaded combination for any central bank, weakening activity and rising inflation. My guess is that the present Monetary Policy Committee would do its best to look through the inflation and support demand as much as necessary for as long as necessary, of course.
So that suggests more QE, or at least no tightening anytime soon.
Exactly right, yes. Yes, I would.
Okay. Yeah, thank you very much. Larry, a question for you. Do you think that the Fed has a credibility problem? You know, if you look at market pricing compared to what, you know, to what the Fed's own forecasts in the S&P say, the market, although it's become a little bit more of a believer, is still rather skeptical about 3 or 4 hikes a year.
Well, I think two things. If the economy evolves as the FOMC anticipates, markets will adjust accordingly. As the Fed moves again, say in June, the markets will come to see the message. What's important for the Fed is not that they don't anticipate the same number of moves, but they do want to communicate their intentions for the upcoming meeting, so there's no surprise at that point. And as that process evolves, markets will catch up. So communication is very important. The Fed doesn't like surprises. Policy works best when you can communicate your intentions. But sometimes, look, the markets have been right time and time again. Let's give the market some credit here. Okay, at some point, they're going to be wrong. Okay, and I think this year is one of those times, but not in a way which is very disruptive.
Okay, that's very good. Thank you. George, back to you. You painted a very eloquent picture about how the Communist Party leadership is buying itself time, buying itself stability, buying itself decent growth this year, but at the cost of yet more credit expansion. Can China avoid a Minsky moment, or for how long can China continue to avoid a Minsky moment, do you think?
Dan, I think the first question is probably the easier one to answer, right? I don't think it can be avoided. I don't think at the same time it's going to look anything like ours did in 2007, 2008, simply because if basically banks fail, usually because they become illiquid, then the People's Bank of China will provide any amount of liquidity needed, in a state-owned banking system to ensure that the major players don't fail, and they won't. So it'll be kept under wraps in that sense, relative to the kind of banking kind of implosion that we experienced here and in the United States a few years ago. But that doesn't mean to say there isn't a cost from it. Somebody always has to pay, and the Chinese, whether it's Chinese government or Chinese citizens or Chinese companies, will pay as a consequence through a protracted period of low growth. The second question, which is how long can it be avoided, is as hard a question to answer as it might have been for us in 2004 or 2005. And so my feeling is that what I'm looking at really is I'm not really looking at the debt side or the asset side of the balance sheet in the banking system, because the government can basically evergreen the loans, as everybody knows, in all sorts of ingenious ways for a long period to come. And that is, whether that actually means it becomes a major issue in 2018 or 2023, I've absolutely no idea. What I think is less avoidable, or less unavoidable, I should say, is the liability side of the banking structure. Now, if you look at the IMF's Global Financial Stability Report last October, they already corroborated what a lot of people had calculated privately, that the proportion of wholesale funding in the total funding, the liability structure of the banking system, had risen from 10 to 30%. Between 2010 and 2015. Just very crude calculations suggest that that's even higher in 2016, maybe up to around 33 or 36%. not the big four banks, but for the array of non-banking financial institutions and for city commercial banks and other smaller banks, that proportion maybe already be somewhere in the region of 45 to 60%. And it's continuing to grow with a proliferation of wealth management products and other very, very short-term maturity funding sources, particularly in the interbank market and the interbank bond market. So if you kind of twist my arm, I don't see any reason why anything should blow, as they say, in 2017. But I think that after the Congress, so in other words, sometime in the second half of this term of office for Xi Jinping, which I would say is somewhere between 2018 and 2020, is is the time in which, depending on policy actions, I think we will see some material change for the worse, obviously, in the financial system.
Okay, that's very kind. Thanks very much, George. And I do agree with you. It seems inevitable, if not easy to time. Larry, you've talked eloquently about the FOMC and its strategy and its need for communication. But to what extent do the policymakers at the Fed have to take account of the success or otherwise of Trump's policies? If he gets tax cuts through, how do they react? If he does infrastructure to any degree, how do they react?
Well, that's very simple from the standpoint of best practice central banking. A central bank like the Fed takes into account every event that happens that's a surprise or wasn't in their forecast. Fiscal policy is just one of them, as they like to say, to kind of have a nuanced view there. If there's fiscal stimulus, then the Fed will do its best to completely offset it. They're at full employment and price stability. That's where they want to say. If they're successful, this FOMC will try to completely offset it. That means rates will rise higher, faster than otherwise. Now, I think that in this environment, we're going to see somewhat cautious attempts at that. So I think that what will happen is growth will be a little bit higher, the unemployment rate will be a little bit lower, inflation will be a little bit higher, probably somewhat overshoot the 2% objective, but not in a serious way. But I call it Newtonian economics. For every action, there's an equal and opposite reaction. That's the Fed's reaction function.
Okay, but they would never anticipate anything, so you would have to...
No.
Yeah, you'd have to
never
pass something first. Okay, very good. And if we had to twist your arm, do you think there'll be tax reform this year?
No. Maybe never.
Maybe never. Just too hard.
Oh, way too hard. A quarter century? The political forces are not aligned for tax reform. So you might get something on the corporate side with expanded base and lower tax rates, but you're never going to get a really big tax cut, and you're not going to get tax reform. Okay. That would be my view.
Thank you very much. That's very clear. John, turning away slightly from Britain and thinking about the rest of Europe, aren't things getting better and getting better quite quickly? And isn't that a good thing? Isn't that something we should be celebrating? Are European assets cheap?
Yes, what's going on in Europe is encouraging. The economy is slowly picking up to a reasonable rate of growth. Inflation is also picking up. Of course, it's not at a uniform rate across the EU, but it's picking up towards the sort of target which the ECB wants. It has you can't say yet that and irrevocably entrenched, but it's picking up nicely, and it's encouraging to the citizens of Europe. It's helped, of course, by the fact that the US has got the sort of strengthening recovery which Larry's been talking about. It's helped also by the fact that the emerging markets, the commodity producers in particular, seem to have bottomed out and seem to be growing a little bit themselves. So that means that globally the outlook is a little bit better, and within it, Europe's own outlook. I think what's also happening in Europe, remember this is a year in which politics are going to influence events probably as much as pure economics. The attitude that President Trump has taken towards Europe, the attitude which the Brits have taken towards Europe, seems, as far as one can tell from talking to people and from European somewhat, Perhaps they feel slightly beleaguered, perhaps they feel slightly alone, perhaps individually they feel here as a group. I could, of course, be quite wrong about this, and we may see Marine Le Pen win ultimately, in which case all bets are off. But it is looking today as if Europe is a little bit more solidaristic, to use their word, than it has been, and that's being reinforced by an economy which is picking up gently, with inflation also picking up gently, but not to the point which will in any sense be troublesome. So mildly encouraging, I think, is the right thing to say at the moment.
Thank you very much. You mentioned emerging markets there, and I was going to ask George, and this is also a question that's come from one of our viewers. As the US turns more protectionist, which of the EMs is going to hurt the most, do you think?
Well, so far, it may not last, of course, but so far, a lot of the protectionism from the administration has been sort of bluster rather than substance. I mean, it's not encouraging. I mean, I don't find it encouraging, obviously, that one of the first things that Trump did was to withdraw from the TPP, and obviously NAFTA is going to be renegotiated. The worrisome thing, I think, really, is if trade is going to be used as a tool to weaken China. I mean, and we must remember that the Obama administration and the Bush administration before it both had spats with the Chinese, which were taken to the World Trade Organization. In fact, the new administration under President Trump inherits a number of issues that are unresolved and under jurisdiction of the WTO for resolution. And the Chinese themselves actually lodged a complaint against the United States and the EU in the WTO at the end of last year when they refused to grant China market economy status. But, you know, these are what I call trade spats. These are things that they've happened a lot and they crop up all the time. And generally speaking, they take time to resolve, and they will be generally, you know, they generally tend to be sorted out. What I'm a bit more worried about here is that as you said in your question, that the protectionism, the zero-sum game approach to trade is going to take the form of a more aggressive approach to China in particular. I mean, I don't think the Americans are really, I mean, Larry is on the line here, so he can comment on this too. I don't think the United States presidency is kind of triggering or has got its kind of got anybody particular in the crosshairs of trade other than China and Mexico specifically. Not that has been made public, at least. But I think this would be worrisome, because I think if the United States and China did get into a series of trade disputes that may start with one sector and then leads to retaliation and so on and so forth and other sectors, then I think a lot of emerging markets could be drawn into this vortex, and it would be very unfortunate, I think, particularly, as I said before, because there is some anecdotal evidence that the volume, I mean, the value of world trade is picking up because commodity prices have picked up, but the volume of world trade, which has been pretty dormant, is showing, you know, some slight signs of life, which is obviously a good thing, but it could be snuffed out if this protectionist view increases in intensity.
Yes, I completely agree with you there, George. Thank you. And that is actually a good question for you, Larry, which is that, you know, does this affect? Does it have a boomerang effect back into the States? The States, whatever the States does affects the rest of the world. Does the U.S. administration, the U.S. government, and does the Fed have to take account of what's happening in emerging markets? We've seen that the Fed can be derailed. We learned that lesson over the last couple of years. Do you think they are taking more account of what's happening in the rest of the world these days, or possibly less?
Well, I think that's always an interesting subject about how the Fed responds to developments in the rest of the world. And I think the story is the Fed doesn't think of itself as a central bank of the world. Of course, it takes into account developments abroad as it would fiscal policy in the US, and it affects their forecasts. But it doesn't sit around and saying, is this good or bad for emerging markets? Okay, unless we're in a situation where it could cause financial disruptions in financial markets or feedback so aggressively to the US. So I think the story here is that some of these trade initiatives could be very disruptive to the global economy, to the US. Equity markets will not take these well. Okay, and so there are forces. While fiscal policy is an upside risk, everything else Trump could do are downside risks for the US economy.
Okay, but the Fed sees it all through the lens of the US and has to continue to do that.
Absolutely.
Yeah. John, in Europe, is the ECB going to move this year? Is there going to be somewhat of a curtailment of the easy monetary policy stance, or is it just going to keep right on going through the end of the year with its current QE and lower for longer?
I would be very surprised if the ECB were to do anything this year, which it seems to have, which is slowly accelerates, not yet a deeply entrenched recovery, inflation picking up, sense getting out of control. I think one would call that a fragile recovery. Fragile recovery, you do want to be very careful not to knock it before it's fully entrenched. And that, of course, takes you, amongst other things, back to Brexit. The European Union is 4 times as important to Britain as Britain is to the European Union. But nonetheless, a major country is now talking about fundamentally changing its relationship. To see that can be positive, hard to see how that can be constructive for the European economy. That's another small challenge to it, which would make the ECB cautious. But if I may, could I broaden out also to another
Please.
point? If you take the things which the three of us have been saying collectively, in the post-war historical perspective, it adds up to quite a concerning picture. You see, anybody who's under about 80 years old now has lived really under one global regime in the West, a regime of free trade, free movement of profits, free movement of capital, very much pursued actively by the United States, using the institutions which it was instrumental in building at the end of the Second World War, the IMF, national settlements which existed before but which it has always supported, the GATT later to become the World Trade Organization. All of these organizations in which the US has been a substantial budget contributor, but even more importantly, it's been a substantial supporter. And now, for the very first time, you've got a United States administration which is starting to call those institutions and those practices into account. And as if that's not enough, the whole edifice has been underpinned by the Pax Americana, by the fact that the US was the only superpower and was determined to use it to maintain world peace. And that's been called into question just a little bit at the margins now by President Trump, calling into question the validity or the appropriateness or the usefulness, whichever word you want to use, of NATO. So I'm not saying we're at a turning point. I can't predict the future well enough to say that. But what I can say is that the institutions and the practices and the military underpinning the last 80 years nearly is being questioned. This is therefore an uncertain time, whether you're in the United States, although there it's the least uncertain time. It's more uncertain if you're in Europe, and it's distinctly uncertain if you're in Europe. I suggest point to central banks who want to be careful not to snuff out such recurring growth as we now seem to have.
So that you're saying you're appealing to policymakers to be careful, because if you look at investors, at least for the last 5 or 6 months, they seem to have just been heading one way, which is up. And the VIX, I think I'm right in saying the VIX gauge is pretty low and has been consistently low for a while. So perhaps some sort of cyclical upturn is masking a greater structural rise in uncertainty.
Precisely. I mean, there are good just saying what you're saying in different territory. There are good proximate reasons seen in markets in most countries. But when I look behind that at the risks to the world's architecture, which is so uninteresting in some ways to the great majority of people that they never really need to think about it, I can't help expressing some concern.
Yeah. Do you think, Larry, that the Trump trade will turn out to be an illusion in the end? We've got no healthcare reform. We're not going to get tax reform. We're not going to get infrastructure spending. Perhaps by the end of the year, equities will be down and Treasury yields will be back below 2%. What do you think?
Well, equities are extremely vulnerable. They're very rich, and they're based on a very optimistic view of business-friendly policy and implications for that part of the economy. I think, however, with respect to trade, that he doesn't get health care, he doesn't get tax reform, doesn't get infrastructure spending. He needs a win. A win might be a loss, but okay, what he thinks might be a win. And the way to do that is to do something he could do at his own initiative with executive order and his broad powers with respect to trade. So I agree that the most likely situation is targeted protectionism with respect to, say, China in particular and specific industries. That won't be a very good idea in terms of reactions. It'll be very disruptive, and it'll be hard for Trump to back away. So I think all of these things are risks. I mean, trade is the only major policy instrument, immigration too, but trade is the one where Trump has the ability to do on his own, and that's a problem.
Yes, I think that is a problem. So he'll grasp at whatever he can actually get done. Yeah, I think that's a real risk. Do we think back to you, John, and back to your favorite topic? Do you think there's a likely blow up in the negotiations, in the Brexit negotiations, now that Article 50 has been triggered, or do we think that actually behind her hard exterior, Mrs. May is really a bit of a softie?
Softy, but she's made it very clear, and she would, it doesn't surprise me at this stage, that she would like an orderly exit on the best possible terms. And the Europeans, for their part, have indicated that they would like to see an orderly set of arrangements on the best possible terms. Case by that they have to show Britain that it's not going to fare quite as well outside as inside. Discourage others from perhaps trying to cherry pick in the future as well. So I don't doubt, contrary to what is sometimes said, that both sides go into this pretty determined, if they possibly can, to negotiate in a decent way and in a fair way and in an unemotional way and non-histrionic way. But there are risks to this because, of course, there are interest groups. Frankly, what I fear, almost more than anything else, is the negotiations starting in the wrong way, and then the British tabloids absolutely poisoning the discussion. I'll explain to you what I mean by that. Said, and I rather hope it doesn't do this, but it said that it wants to settle the divorce bill, the money that Britain will have to pay it in order to settle it's entered into over the past 44 years, before it will even begin to discuss trade. I hope it doesn't do that. The trade negotiations, even in the best of circumstances, take a long time. The Canada-EU one, for example, started with 2 years of scoping discussions and then took 7 years to complete. Negotiation was only about goods, it wasn't about services. If you start this evening on trade negotiations, 2 years looks like a very short time. And if it doesn't start straight away because there's haggling over the divorce bill, that will shorten the time available for a trade. But worse, the divorce bill, if intelligent way. You owe us 60 billion and we won't even talk to you until you do, I think would probably cause the right wing of the Tory party and the tabloid press to explode in jingoistic extremism anger. And that might then lead to the talk starting back.
Right. No, I think that
it's a real risk.
Yeah, I think you're right. That is a real risk. George, I wanted to come back to something you said earlier, and you mentioned you called him Uncle Xi, but I think he's generally acknowledged as probably the most powerful Chinese leader since, well, Deng Xiaoping at least. Do you think there's a risk here, a political risk, that Xi Jinping decides to stay on longer than the traditional 2 terms or 10 years, and that we're heading back to a, well, I don't know, dictatorship, not to put too fine a point on it?
Yeah, I mean, by popular, or I don't mean popular, but widespread agreement, I think people understand that Xi Jinping has amassed around himself a degree of control, which is quite unusual. Looking back to the days before Deng, actually. So to the Maoist period. It's not clear, I think, except maybe to those China watchers that have deep and trenchant insights. It's not clear whether Xi Jinping is actually a very powerful president with a lot of power, or a relatively weak president who has amassed a lot of power. That the determining factor might be actually how 2017 evolves and actually what happens at the Congress, because obviously at the Congress there will be, I mean, strictly speaking, all but 2 of the 7 members of the Politburo Standing Committee, which is him and Li Keqiang, are supposed to step down because of age restrictions. Now that may be relaxed because there's one member of the Standing Committee that I think the president wants to have with him all along, which is Wang Qishan, who runs the anti-corruption campaign. But yeah, I mean, I think the question you ask really is about whether, in effect, the question is about whether the normal practice of appointing at least two new members to the Standing Committee, from whom the next leadership would be chosen, whether that actually happens, or whether the president and the leadership basically are intent really to have Xi Jinping continue for the foreseeable future, which means beyond the next 5-year term. I mean, I think there's a sporting chance that'll happen, actually. And I think his position actually has been strengthened by the gift he's received from the new US administration. So this, I mean, it was almost too good to be true that he actually, went to Davos for the first time a Chinese president has been there, and appeared in front of the global elite as the protector of free trade and globalization. Come on, but actually that's how it was. That's how it came across, and that's how he played to that gallery with great aplomb. And I think the whole, the series of incidents that we had before about, the one China policy, which Trump questioned, then pulled back from, and then the kind of the rhetoric about protectionism. I mean, I think what we've heard already is quite correct, actually, that in the search for a win, the president may actually up the ante on trade. But for the moment, the rhetoric has kind of calmed down a little bit, and Xi Jinping can actually appear in China as having been the cool, calm, collected leader who didn't rise to the bait, and is presiding over control over China's most important external relationship. If he lost that control because of a trade dispute, mind you, that would be pretty serious. So actually, from a game theory perspective, if I was the US administration, I'd want to push this trade dispute business quite strongly in 2017, because it might be that the Chinese would swallow quite a lot for the sake of keeping an even keel.
Yes. Yes, that's a very good point. Larry, if I may back to you for a quick one. You said in your opening remarks that Donald Trump would want a dovish Fed. That's very different from what he said on the campaign trail, I think. But I guess you change when you're actually in charge of the economy.
Apparently. Yeah, I mean, we have to see what he wants. Okay, he doesn't want a hawkish Fed. My goodness, that's the rain on my parade. A Fed that wants to lower growth over this period to trend, which might be 1 3/4. That won't be very responsive to a potential of faster growth. They will be focused on not exceeding the inflation objective. Those are completely opposite. You have to start from the fact that he's promised jobs, jobs, jobs. He will never get a fraction of the jobs created under the Obama administration. It's likely to go down to 100,000 or less by the time we get to, say, 2019. But for the moment, he wants jobs, he wants growth, and he doesn't want a Fed which is going to interfere with that. So that means a dovish Fed. And remember, he's a developer. Developers just love low rates. That's their life.
That's true. And if I, because we're getting towards the end of our slot here, if I asked you to sort of give us your view, your outlook on the main asset classes in the U.S., equities, bonds, the dollar, what would you say?
Well, equities are very rich given the potential of policy lack of success and policy blunders. The equity market is very, very vulnerable. With respect to fixed income, of course, that will depend a lot on what happens there. If equities were to fall a lot, then rates will fall too. But otherwise, the markets aren't quite aligned with the Fed's pace of tightening, so that there's some risk of sell-offs in the bond market should the economy evolve as the FOMC anticipates, which is what we anticipate as well.
Okay, and that would presumably suggest that the dollar should remain relatively strong.
Well, there are countervailing forces here, obviously, but I would say that remain about where it is the best guess, given that exchange rates are so impossible to forecast.
Okay, fair enough. Yeah, no, that's very fair. And I didn't want to put you on the spot too much. I think we've briefly lost John. George, what do you think about either the dollar or the euro or any favorite asset classes out there? Anything you can see that has good value?
So I've been quite optimistic about the dollar, and I think it is obviously quite disappointing from my point of view that it's suffered this setback since January, where I suppose it's just a kind of a little bit of a cold shower over the optimism that was implicit in the market around, surrounding Trumponomics, really. I suppose my concern, I as a kind of my base case really, is that if Trump even only gets, 20% of what Trumponomics was supposed to deliver in 2017, but we get a kind of a backloaded installment in 2018, then I still think that the dollar can advance quite appreciably, actually. But I think at least tactically, which means for the next 3 or 4 months, I think the dollar will remain on the back foot, actually, because I think that John was talking earlier about, the sort of upside risks in the EU economy. I think not enough people have actually noticed what's going on there, actually. And if Macron, obviously with opinion polls, you never know what to believe nowadays. But if the opinion polls suggest that Macron has a decisive lead, even in the first round, not to mention the second round of the presidential election, whatever happens in Europe over the next 5 years, there'll be a huge sigh of relief, I think. So actually, I think the euro's got some upside here, both against a kind of a languishing dollar, but also against a pound that is going to be increasingly sensitive to every twist and turn in these Article 50 negotiations, actually. So yeah, I'm a bit of a kind of a Euro fan, at least tactically, but not necessarily strategically.
Okay, and I think that's very fair. Okay, well that's great. I think honestly we're 2 minutes from the end, and thank you. I want to thank everybody for their contributions. Larry Meyer from the US, John Llewellyn about Europe and the UK, George Magnus about China and the world. Three very distinguished speakers offering up their time for us. And if you've enjoyed it live, you can watch it again as a recording. If you've missed any part of it, you can go back to the beginning. It'll be posted on YouTube. Thank you very much, gentlemen. It's been very informative, very enjoyable.